Hi everybody, and welcome back to video 2 in chapter 24. When we left off, we were looking at evaluating the payback period. The payback period's strengths, of course, use cash flows. It's easy to compute. I always use simple, as I call it, payback, because it's a measure of evaluating risk. The longer it takes to pay back, the more nervous I get. And I think most tenured managers that do that kind of calculation understand that. The longer we have to forecast in the future, the riskier it's going to be. What is its weaknesses? It ignores cash flows after the payback period. So if you have let's say you have very little cash flows in the second, third, fourth year or something like that, but you've got millions of dollars in the fifth period, it doesn't take that into consideration. It ignores the time value of money. So we have to do some other calculations in addition to the payback period. I don't typically use accounting rate of return that much, but I will go through it academically, so at least you know what it means. Here, the accounting rate of return is an investment's annual income. Notice that's income and not cash, divided by the average amount invested in it. So the decision rule then is we're going to select the investment that has the highest accounting rate of return. So our average investment here is going to be our initial investment plus the salvage value, not less the salvage value, divided by 2. And in this case, there's no salvage value, so this average investment here is $8,000. The accounting rate of return then is the annual income, that's $2,000, divided by this average investment that we got here. And that gives us a 25% accounting rate of return. Accounting rate of return, again, ignores the time value of money, and it does not directly, it uses income, not cash, directly consider cash flows and their timing. Net present value and describe its use. This is very important. And I will provide a second supplemental file on this, which we'll go through in the videos after we're through with this PowerPoint. But net present value is probably the most important of all these analytics that we're going through in this chapter. We take a net present value and apply the time value of money, as you just saw in my first supplemental file on the basics of time value of money, to future cash inflows and future cash outflows, so management can evaluate the project's desirability. How do we do that? We discount the future cash flows from the investment at the required rate of return, and then subtract the initial amount of the investment from those future discounted net cash flow. What is that required rate of return? Sometimes we call it a hurdle rate, sometimes we call it a discount rate. It's typically its cost of capital, and that's the average of the rate the company must pay to its lenders and investors. Okay. Here is an example. The company is considering a $20,000 investment in a machine that is expected to provide $10,000 of annual net cash flows for 3 years. The company requires a 9% annual return. So they're using the book value that I showed you briefly in the first Excel spreadsheet, how they calculate that. You'll find these factors in the present value tables in the back of the book. We're going to multiply these factors. Where we divide by my factors, we multiply by the book factors. So the present value of the first 10,000 is 91.74, and then 84.17, then 77.22. So the total present value of these net cash flows of 30,000 is 25,313. We back out the initial investment, which is already at net present value, or present value, because it's in period 0 that we make that investment, and that gives us a positive net present value. Now, what's the decision rule? The decision rule is if the net present value is greater than 0, then it represents a good investment. And here that net present value is greater than 0, so it represents a good investment. And down here, don't miss this little bullet point, you'll find these factors in table B.1 in Appendix Bravo. Okay. Now these have equal cash flows. Now, when an asset's expected net cash flows yield positive net present value, which it did in this last example, then that means that we would invest. If it doesn't, then we would reject that. So if we're comparing investment projects, very important here, similar cost and risk, we'll invest in the one that has the highest net present value. Pretty straightforward. We can adjust, however, and I usually do, this required rate of return. If I have a project that's particularly risky, I want a better rate of return to compensate me for taking that additional risk. So I might use 15% or even 20%, depending on how risky that project is. All right. So the present value could have an annuity assumption. We can simplify that calculation if there's a series of equal cash flows. So if there's a series of equal amounts, we call that an annuity. And in this last example, there was an equal amount of annuity for 10,000, 10,000, and 10,000 in the first 3 years. We can go and use a different present value table to calculate the present value of 3 years at 9% interest. And that is this 2.5313. That simplifies doing this. Boom, boom, boom. If we add those all up, we're going to get that 2.5313, which is done for you in the present value, a separate present value table for 3 years at 9% interest. Okay? It's still going to take this 25,313, which is 10,000 times that present value factor, and then we subtract the 20,000 initial investment. We still get that same net present value of 5313. It just makes it a little easier when we have equal cash flows. That's rarely the case, however, but we can. Now, let's apply that assumption to some strategic plans here. Here, we have a net present value to decide whether we want to automate a production process. We're constantly looking at those kinds of investments. A manufacturer is considering investing $80,000 in automated manufacturing system. That investment can reduce labor costs by $15,000 per year for 10 years. The company uses a 10% discount rate or required rate of return, or whatever you want to call that, and a 0 salvage value. So we look up the present value of $15,000 for 10 years at 10% discount rate, and you'll find that in table Bravo.3. Okay, and that is 6.1446. So the present value of an annuity of $15,000 for 10 years, totaling $150,000, is the present value. It is $92,169. We subtract the initial investment already at present value of $80,000, and we generate a positive $12,169. So this is a good project. Although both projects now, we're going to take a look now at unequal cash flows. So all that means is we need to go into the tables and separately do it. And here are those tables from the first present value table in the book. And we have two competing projects here. We multiply them through to get the present values, and both of them are good investments. And they both have, but project B has a higher net present value because of the larger cash flow here in period 1 compared to project A. So that gives us a better, much better present value. So naturally we would choose project B if these were mutually exclusive projects. And if we have to apply salvage value, it's the same principle here. We just take the $15,000, and our cash flow then is we have an additional $10,000 of salvage value at year 10. So we use the annuity to calculate the $92,169, but at the end of year 10, that $10,000 present value is $3,855. We add that to the $92,169 to get $96,024, and we back out the $80,000 to get to net present value of $16,024. So hopefully a salvage value is sometimes called a residual value or a scrap value. It's the additional net cash inflow that we expect to receive at the end of that asset's life. I used to have equipment made out of stainless steel. And when this equipment was fully used, I could sell that stainless steel for scrap value. Okay, so if I compare, this looks like a good place for us to stop this video. And when we return, we'll take a look at how we compare net present values. Until then, bye for now.